looking to switch from a variable rate to a fixed rate and you don't know what the right deal might be for you. Well, Peter White is the Managing Director of Finance Brokers Australia. Peter, thanks for joining me on the Drive program. What kind of questions should we be asking of mortgage brokers and banks at the moment?
The critical one at the moment is, of course, what's your interest rate, and making sure that the interest rate that the lender is talking to you about or the broker's talking to you about fits within a reasonable bracket. And at the moment, before Tuesday's announcement from the Reserve Bank, you sort of hope the interest rate should be somewhere around 2.5% to 2.6%. If they're 3% or higher on a variable rate, probably think that's a bit expensive at the moment. So interest rate's always a key one to ask. And then, of course, fees. What's it going to cost me? And you need to make sure there's not a whole lot of fees that are bundled up on top of everything else. Because sometimes, a really cheap interest rate sounds great, but by the time you add all the fees on top, it's not so great. So interest rate and fees are a couple of really key things to be asking right up front with whoever is organising the loan for you.
And what kind of negotiating power do you say we have when it comes to new mortgages? Can you really grind down and ask for a better interest rate? Surely that would be something that they're not overly friendly and negotiable about.
Yes, in the current environment, negotiating interest rates is a bit tricky. Everyone's putting their rates up, and as the Reserve Bank moves the cash rate, you can guarantee rates will move with the same amount. So negotiating an interest rate really is difficult in the current climate, and I would recommend that you always give it a go, but don't be expected if there's not much room to negotiate, because they're all looking to put interest rates up, not to bring them down. But on that, the thing you probably can negotiate on is fees. So make sure that you try and screw the lenders down on their costs. So that's one area that you probably have got some room to move on in the current market.
And what about, say, for example, a lot of people, when you ask them, don't know, is their loan 20 years their home loan? Is it 25 or 30? What advice do you have for people who might be on a 30-year home loan, but they could actually afford slightly higher repayments? Will that make a massive difference?
Yeah, so the loan term does make a big difference on your repayments, and then how quickly you pay it off. So, if you are on a 30-year loan term and you can afford to pay a higher amount, that 30 years could become 20 or 25 years. And you always got to remember that all you're doing is by extending the loan term is paying more interest. So that all goes to the benefit of the bank, not to the benefit of you. So if you can afford to pay more, and quite often it's beneficial to pay weekly or fortnightly, even if it sounds like a similar amount. Interest on home loans is calculated daily and charged monthly, right? So if you can pay off more, a little bit more on a weekly basis or fortnightly basis, the interest calculation slows down because it's not calculating on the full outstanding amount. It's always reducing a little bit. It's a little sneaky trick in the banking system. If you can pay weekly or fortnightly, even if you're, for simple math, if your repayments are $400 a month and you paid $100 a week, well, that would be more payments over 52 weeks, and you'd stop the interest rate calculating on the full 400 or the full balance of your loan amount during that time. It's just a little play, a little bit of help. So being able to pay it off in a shorter term and or paying it off on a more frequency, like weekly instead of monthly, all helps to pay your loan off sooner.
And are the banks or brokers, particularly banks, I guess, are they helpful with that sort of thing? Like if you're on a 30-year term, they've probably got no interest in really helping you reduce to 20. Is that a complex thing to do, or is it really quite straightforward?
It is straightforward to do, but I wouldn't think your banks will openly recommend it. They might. Brokers will certainly let you know what your options are in regards to those sorts of things. And it all comes down to what works in your best interest the best as a borrower. And sometimes you just need to meet the monthly payments, and that's what it is. Other times, if there's a bit of surplus money around in your private cash flow, then you're better off to try and pay a little bit more off quicker and stop letting the banks just sitting on the big lots of interest that they put into their bank accounts themselves.
Now let's talk about what brokers do for anyone who is a little unsure. If you were negotiating for somebody, how does a broker work versus going direct to a bank? What is the benefit to the customer?
Brokers these days, and it's different from 10, 15 years ago, but brokers are under what we call a legal obligation called a best interest duty. And that means, and even though brokers would always argue the case, have always done this, but the broker has to put the borrower's best interest in front of their own. So regardless of what they may or may not earn as a commission for a loan, regardless of how they may feel, they must always work in the best interest of the borrower. Now, the banks are not under that obligation. Yes, they're governed by the Banking Code of Practice, but it's a very different set of measures to what brokers are under. And brokers are audited and reviewed by the regulator on this. So they are there looking after and ensuring that they look after your best interests all the time. So it's quite often interest rate is a big part of that question, but it's not the only part of the puzzle that you've got to remember, because sometimes cheapest isn't best. You've got to look at whether you want an offset account or you need to redraw money, whether you should take a fixed rate or variable rate, whether you want a credit card with it or not. There's a whole host of variables through that the broker will guide you through and make sure whatever that outcome works for you the best as possible as one can.
And do you pay a broker in all circumstances or in some circumstances? How does that work?
No. Mortgage brokers are paid by the lender. So they get a commission, and it's a part of, from a lender point of view, it's a cost of distribution. So there's no difference in the interest rate. So whether I go into a branch and the bank's cost is the branch network to run, or I go to a broker and their cost is to pay the broker, it's the same interest rate across the board. In actual fact, brokers are the one back in the 90s that brought the margin on top of the cost of a home loan right down from what it used to be. So usually it used to be about a 4 to 6% margin above cost of funds for a home loan. These days there's only 2%, and that's because of the competition that mortgage brokers brought to the marketplace. So the broker, it doesn't cost you any difference whether you go to the bank or the branch, go to the bank branch or to the broker, but the broker's got a lot more options for you, all at one point, all at one shop, and they'll help work out what that best interest piece is for you.
And now, if people are not happy with their current mortgage lender or the rates, of course, probably a lot of people are not happy with the rate because they'd rather pay less. I mean, is it actually true that you can pitch for a better rate? Is that something that you know of people doing and achieving?
Yes, for quite some time we've been able to pitch for cheaper rates between different lenders, but that was in a declining interest rate market. These days we are heading into interest rates going up. So trying to pitch and to negotiate for a cheaper interest rate is really difficult, potentially not even possible in the current environment. But fees that the lenders charge is something we certainly can work to negotiate. And of course, I'd try and pitch for a cheaper interest rate anyhow, but don't get upset when the answer's not necessarily in your favour. Interest rates and cost of funds are going up. So it's a part of a new world we have to live with. The first time in over 11 years that we've had interest rates going up. So it's going to be a difficult time, but one that we all need to deal with.
Someone's texted into the program asking, under what circumstances can you buy land without a deposit? Is there any circumstances that you don't need a deposit?
Yes, there is, and it's the same as if you're buying a house as well. But what it means is you already need to own a property or have a property with equity in it. And what the lending credit policy does is what they call cross-collateralise. They take security against both properties, and if there's enough equity there, you don't have to pay a deposit on the one you're buying, whether it be a vacant block of land or even a house. So it's what they call cross-collateralising the security. So they take security across both properties and you don't have to pay a deposit. And you may not have to fork out any fees or anything either. They could probably build it into the loan. But you need to either own or have a reasonable amount of equity in the property that's being used as the other security.
And just finally, the big question everybody wants to know right now, with interest rates set to rise and I believe another evaluation set for tomorrow, are we better to lock into fixed? I mean, what's your recommendation when clients come along, or do you just stick with your variable rate?
It becomes very particular to a person's circumstances to whether they want to fix an interest rate or not. So my rule of thumb at the moment is if you plan to do nothing with your home loan except make your everyday monthly payment for the next 3 or 4 years, or let's call it the next 3 years, be a bit simpler. If you can get a 3-year fixed rate that the first digits are 3, it's probably a good rate to fix in. But if you're planning on doing something, so you may be doing a reno, putting in a pool, you may sell in 2 years' time. If you've got some plans that they're going to change the status quo of your home loan, you've got to be careful taking up a fixed rate, because when you want to get out of a fixed rate, it can cost you a lot of money, and nothing unusual for a $10,000 or $15,000 fee to get out of a fixed rate. So you need to be careful if you do that. So you've got to weigh up the pros and cons. You've got to look at your personal fixed rate's the right thing to do or not. But the thing you've got to be careful of is that interest rates, as we're talking about today, are all going up. And just because you've got an interest rate that's 3-something%, when you come out of that interest rate, it might be 5-something%. So you've also got to be able to make sure you can afford that higher interest rate when you step out of the fixed rate, as they've been going up for some time to come.
Well, thanks for sharing your perspective, Peter White. Good to get your thoughts. Thanks for joining me on the Drive program.
My pleasure. Thanks again for having us.